So thanks for joining us, Jonathan. I've just given an introduction highlighting how experienced you are. And look, I might kick off with one of the questions I often get asked, which is, why might an investor consider any investment into the AREIT sector?
Thanks, Steve, and look, good morning, everyone. As we know, commercial property is a great asset class which has the opportunity to deliver investors some solid income levels. And I guess the AREIT sector gives you a sort of an easy way to access that, given AREITs trade on the ASX on a day-to-day basis. So when we think of some of the key reasons why you want to invest in AREITs, clearly there's that liquidity, that daily liquidity you get. Also the high income levels that are available. So your typical AREIT is probably delivering you about a 5% yield at the moment, which is pretty good. Total returns have been great. So if we look at sort of the last 10 years ending December last year, you're talking about an average return of about 11%, which is very strong as well. Diversification, so there's lots of choice for investors. Not only can you invest in REITs which have office buildings, shopping centres and industrial facilities, but these days there's additional alternative sectors like childcare centres and even service stations. And maybe the last thing to round it out is just that underlying intrinsic tangible value you get from the real estate, which is nice, I guess, in this day and age of tech stocks where some companies may have no profit or maybe even no revenue.
And so you touched on something as well, Jonathan, that I guess AREIT's been listed on the stock exchange are liquid. And look, when I talk about a lot of the direct funds today, they are unlisted. So I guess investing in AREITs does provide that additional liquidity. Can you maybe give us, our audience here, a bit more colour on how the AREIT sector's placed, say, against the more broader general equities markets?
Yeah, sure. Looking across the AREIT sector at the moment, it's had a great year, and you've seen a lot of share prices bounce back strongly. Fundamentally, also, we're seeing improvements in rent collections, we're seeing earnings upgrades, distributions upgrades. We're even seeing managers buy back their stock, and generally that's a sign that there's good value there. But when we look at valuations in the sector, we see really good value. So firstly, from a traditional PE perspective, AREITs look pretty good, probably cyclical lows versus general equities. And also, if we look at them in terms of the yields that you're getting versus interest rates, they look pretty attractive as well. And the last point really is about looking at them versus their net tangible assets. There's plenty of REITs trading at discounts. And when you see that, to me, that generally signifies value.
So you brought in some technical terms there, Jonathan. PE, price earnings multiple. It's probably a good lead into the next question I was going to ask is, what's the benefits of hiring a professional in this space to pick stocks versus, as you said, they're listed. Theoretically, anyone can go and buy and sell them themselves. Why would you potentially hire a professional in this space?
Yeah, look, the sector is always evolving, and as a manager, we spend a lot of time obviously understanding themes and what's changing in the sector, and I think that's the key difference. And if you think about one of the key themes at the moment, it's the growth in e-commerce. That's having a huge impact on different types of real estate. So on one hand, you've got the industrial warehouses where if you buy something online, it's going to go through a warehouse before it gets to your house. And they're doing really well. Those prices are being really well bid for. At the other end of the spectrum, you've got the traditional sort of discretionary malls. Think Westfield shopping centres. They've been incurring falling rents, rising occupancy, and falling values. So if you would invest, let's say, in an ETF, which is basically buys the index,
an exchange traded fund.
Yep. Leading into COVID, you would have been very overweight those discretionary malls, and that would have really hurt you through that COVID period. Whereas as a manager, we've been quite underweight that sector, and we've been able to navigate that period very well.
Okay. And so I guess you apply the expertise not just of yourself, but the broader team at Charter Hall. Maybe if you can give our audience a little bit more detail on how the Maxim AREIT fund actually works in practice.
Yeah, sure, Steve. It's pretty straightforward. Think of your traditional managed fund which invests in shares. The Maxim fund's very similar, but in our case, we own listed property companies. We mark to market our investments every day, so we calculate a daily unit price, and we offer daily liquidity in terms of applications and withdrawals. We also deliver quarterly distributions to investors. But I guess at the end of the day, the thing that's really what we're trying to achieve is to beat our benchmark total return. which is the A-REIT index. And I can say successfully we've been able to do that over a 15-year period.
And look, you saw the slide I put up before Jonathan joined us with the performance. I should also highlight that Maxim performance is on an ex-fees basis, so after all fees. That's the only way we show our returns at Charter Hall, because ultimately it's the after fees returns that investors receive. And you can see on that basis, Maxim, even the last 5 years, has significantly outperformed the benchmark. But look, as I always say at these kind of things, past performance isn't any guarantee to future performance, and always read the offer document in full. Look, thank you very much for joining us today, Jonathan. That gives us a great update on what's happening in the Australian A-REIT sector, as well as touches on some of the key points around the Open for Investment Maxim Fund. Thanks, Jonathan.
Thanks, Steve.